Close your eyes and imagine your worst nightmare. You open your brokerage app and everything is burning red. Your portfolio is down 30%, 40%, maybe 50%. News headlines scream crash, crisis, the bubble is burst. Your brain starts thrashing in hysteria. It screams sell, save what's left, run, you fool. And in this exact moment, while you're drinking sedatives, real investors are popping champagne. You think they're crazy? Masochists? No, they simply know a secret hidden from the crowd paralyzed by fear. Today, I'm here to flip your consciousness. I'll explain why a market crash is the best thing that can happen to your wallet. Spoiler, you're poor not because the market falls, but because you don't know how to use it. We live in a consumption matrix where they've programmed us growth is good, decline is tragedy. This is the banker's lie. If you're tired of losing money to panic and want to learn how to get rich on the market's blood, subscribe and hit that like button. Now we're going to calculate what your panic actually costs you. Get your calculators out. This will hurt, but it's necessary. Let's break down the main schizophrenic disorder of the modern consumer. Imagine you walk into a store for your favorite sneakers or a new iPhone, and you see a price tag, 50% off. Yesterday, it cost $600. Today, it's $300. What do? Do you run out of the store screaming, "Oh God, iPhones have crashed. We're all going to die"? No, you pull out your card and buy two. You call your friends, "Bro, there's a sale. Get over here quick." This is called a sale. You're happy because you're getting value for cheaper. But as soon as it comes to the stock market, your logic shuts off. Google or Nike shares drop 30%, and you perceive this not as a sale on businesses, but as the end of the world. You're willing to buy liabilities, clothes, tech on sale, but you're afraid to buy assets, factories, and companies when they get cheaper. This is economic bipolar disorder, and market makers make their money on it. Let's simplify this to elementary level. What is a stock? It's not a number on your phone, it's a share in a business. Let's say there's a cow that produces 10 liters of milk per year. The cow costs $100. Your return is 10%. Suddenly, there's panic in the market. Everyone's screaming that nobody needs milk. The cow's price drops to $50. Did the cow get worse? No, it produces the same 10 liters. But now, buying it for $50, you get a 20% annual return. A market crash is a mathematical gift.
It's an opportunity to buy the same cash flow at half price. People take out mortgages, overpaying banks millions just to lock in the price of concrete. But when the market gives them the opportunity to buy their future pension at half price, they bury their heads in the sand. Now, let's look at the other side of the equation. Who's selling when everything's falling? Tourists in the market. Those who came to play, to make quick money after listening to successful success gurus. They see red, fear of loss grips them, and they lock in their losses. They're literally gifting their money to the patient. Remember, you haven't lost money until you hit the sell button. As long as you hold the shares, you have assets. Red numbers on the screen are virtual. Reality is the number of lots in your portfolio. A crisis is a mechanism for redistributing wealth from the impatient to the patient, from the fearful to the cold-blooded. The rich get richer in a crisis, not because they know the future, but because they have cash and nerves of steel. When the crowd runs for the exit, creating a stampede, the investor calmly walks through the entrance and buys everything left on the floor. So what do you do if you have an average salary and don't have millions in cash? Cry? No, I'm calling you to the predator strategy. A market drop is your hunting season. If you're in the capital accumulation phase, a market drop is your best friend. Imagine you're saving for an apartment, and suddenly apartment prices drop by half. You'll be upset. You'll say, "Damn, how terrible. Now I only need to save for half the time." Nonsense. You'll be thrilled. So why do you get upset when the stock market falls? It's giving you a chance to shorten your path to freedom by 5-10 years. Now for the concrete plan on how to behave during a correction so you don't become food. Step 1. Kill the speculator in yourself. Stop checking quotes every 5 minutes. It destroys your psyche. Delete the app, save your money. Step 2. Aggressive averaging. If you were investing $150 a month before, during a crisis, find a way to invest $400 or $600. Skip that extra coffee, that Friday beer. Right now, every dollar buys more assets than yesterday. This seems like a fairy tale now, but in stock market crises, such fairy tales become reality. Step 3. Buy fundamentals, not garbage. In a crisis, the weak die. Don't try to catch falling knives in third-tier stocks or trendy startups. Take what the economy can't live without: energy, banks, retail.
Things that will still be working in 10 years. You're building your portfolio brick by brick. But right now, they're selling bricks at the price of sand. Many will say, but what if it drops even lower? What if we haven't hit bottom yet? This is the favorite excuse of panic mongers. They sit on cash and wait for the perfect moment. Spoiler, the perfect moment doesn't exist. You'll never catch the bottom. While you're waiting, the market turns around and shoots to the moon, and you buy at high levels to ride it down. Well, you get it. The best strategy is ladder buying. Dropped 10%? Buy. Dropped another 10%? Buy more. Let your average price be your protection. Math always beats emotions over time. Understand me correctly. I'm not calling you to mindless risk. I'm calling you to cold calculation. The market is cyclical. Spring always comes after winter. Growth always follows decline. This is the law of economics. If the economy doesn't recover, you won't need money. You'll need ammunition and canned food. But if we believe the world won't collapse tomorrow, then the current drawdown is a springboard for your capital. Compound interest works best when the base is laid in a low market. Investors who started buying in 2008 or 2020 are now laughing at those who kept money in deposits. Fear is a tax that the poor pay to the rich. Stop paying this tax. Start thinking like a business owner. If shares of your favorite store dropped, you can buy a stake in it cheaper. You're buying workers, machinery, logistics, brands at a discount. That's genius. On the day when everyone panics, you should be the calmest person in the room, because you know red candles on the chart are a green light for your future wealth. I don't give signals or predict currency rates.